Section 1. What is capital gains tax? Let's break it down. We're going to demystify capital gains tax, explaining what it is, how it works, and why it's important for you to understand it. Capital gains tax is the tax you pay on the profit, the financial gain, when you sell an asset for more than you paid for it. It's the difference between your purchase price and your selling price. This applies to things like real estate, stocks, mutual funds, and gold, just to name a few common examples. You're only taxed on the gain, not the total sale amount. So if you sell something for $100 that you bought for $60, you're only taxed on the $40 profit. The tax is triggered only when you sell the asset, not while you're holding it. You only realize the gain, and therefore the tax liability, when you actually sell. This gives you control over when you pay the tax. You can strategically decide when to sell assets to manage your tax liability. There are two types, short-term and long-term capital gains. The difference depends on how long you held the asset. This holding period is a critical factor in determining your tax rate. Short-term gains are usually taxed at your regular income tax rate, often much higher. This can significantly impact your overall tax burden. Long-term gains get lower, preferential rates. The government does this to encourage long-term investing and market stability. It's a way to incentivize people to invest for the long haul. Understanding the difference between short-term and long-term gains is crucial for tax planning. Your holding period can make a huge difference in your final tax bill. Plan ahead to save money. Smart tax planning can lead to significant savings. Section 2. The big one, how real estate gains are taxed. Understanding the nuances of these taxes is crucial for any property owner. For real estate, holding the property for at least 2 years qualifies you for long-term capital gains. This is a key milestone to aim for when considering selling. Sell before 2 years, and your profit is taxed as short-term at your income tax rate, which can be over 30%. This can significantly impact your net profit. Hold for more than 2 years, and you pay a flat 20% tax on the gain. This is generally more favorable than short-term rates, but here's the catch. Indexation benefits are gone. That means you can't adjust your purchase price for inflation anymore. This change has significant implications. Your taxable gain is simply the sale price minus the original purchase price. A straightforward calculation, but with potentially large consequences. This can lead to a much higher tax bill, especially for long-held properties. The impact of this change should not be underestimated. The loss of indexation is a big deal for long-term investors. It directly affects the profitability of their investments. Always factor this in before selling your property. Consulting with a tax professional is highly recommended. Timing your sale can save you a lot in taxes. Strategic planning is essential to minimize your tax burden. Let's switch gears to stocks and equity-oriented mutual funds. For these, holding for more than 12 months qualifies as long-term. Sell within a year and your gain is taxed at 15%. Hold for over a year and you pay just 10%, but only on gains above Rs1, $25,000 per year. The first Rs1, $25,000 of long-term gains each year, is tax-free. This makes equities very tax-efficient for long-term investors. You can use this exemption every year by planning your sales. The difference between selling at 11 months versus 13 months can be thousands in tax savings. Always check your holding period before selling. Patience pays off. Now, let's talk about debt mutual funds and the recent changes. Before April 2023, holding debt funds for over 3 years meant lower taxes with indexation benefits. Now, any gain from debt funds is taxed at your income tax rate, no matter how long you hold. Indexation is gone for new investments. This puts debt funds on par with fixed deposits for tax purposes. For high earners, this means a much higher tax bill. The main tax advantage of debt funds has disappeared. Carefully compare post-tax returns before investing. Conservative investors need to rethink their strategy. Knowing the tax rules and regulations is one thing. It's about understanding the framework, but strategically using them is how you truly win the tax game and optimize your financial outcomes. Time your sales meticulously to maximize available exemptions and benefits. This strategic timing is crucial to minimize your overall tax liability effectively. Offset capital gains with any incurred losses, a fundamental principle of tax efficiency. This strategic approach is commonly called tax loss harvesting, a powerful tool for investors. When it comes to property transactions, Section 54 of the Income Tax Act lets you avoid long-term capital gains, LTCG, tax if you reinvest the proceeds in another residential home, with a maximum investment capped at Rs 10 crore. Furthermore, Section 54EC provides an avenue where you can invest up to Rs 50 lakh in specified bonds, often issued by government entities, to effectively save on your tax obligations. Remember, these exemptions come with specific limits and conditions, so meticulous planning is essential. Strategically split large capital gains across multiple financial years. This allows you to effectively utilize multiple exemptions and deductions over time. When faced with complex financial situations, it's always wise to consult a qualified tax professional for personalized guidance. With smart and informed tax planning, you can potentially save lakhs of rupees in taxes annually. Therefore, make sure to leverage every available exemption, deduction, and strategic opportunity. Ultimately, the goal is to make the tax rules and regulations work to your advantage, optimizing your financial well-being.